If you are new to investing and looking to dive into the stock market, you've come to the right place. Understanding the stock market can seem intimidating at first, but with the right guidance, it can become an exciting and rewarding way to grow your wealth. In this video, we'll break down the basics of how the stock market works, the key terms you need to know, and how to start investing as a beginner. Whether you're looking to build a solid portfolio or just curious about how stocks can fit into your financial strategy, we've got you covered. Today, we will talk about stock market basics, a guide for beginners. So before we get started, make sure to hit that like button, also subscribe to my channel. Have you ever wondered how people turn their savings into wealth by investing in the stock market? The idea of buying stocks might seem overwhelming at first, but in reality, it's one of the best ways to grow your money over time. In fact, many people build their fortunes by making smart investments in the stock market. Whether you're completely new to the idea or you've been thinking about it for a while, this guide will walk you through the essential steps of getting started. Stick around till the end for key tips on how to make the most of your investments. 10. What is the stock market? Let's start with the basics. The stock market is a place where buyers and sellers come together to trade ownership shares in companies. These shares, known as stocks or equities, represent a small piece of the company. When you buy a stock, you essentially become a part owner of that company. Companies issue stocks to raise money for things like expansion, research, or paying off debt. The stock market provides them with the opportunity to get that money from individual investors like you. There are two main parts to the stock market: the primary market, where companies sell stocks to the public for the first time through an IPO, and the secondary market, where investors buy and sell stocks from each other. The secondary market is what most people think of when they refer to the stock market. It's where most stock trading happens. 9. Understanding stock prices. Stock prices are determined by a variety of factors, but at their core, they represent what investors are willing to pay for a share at any given moment. Prices can rise or fall based on a company's performance, overall market conditions, or broader economic factors. For instance, if a company reports high earnings or introduces a revolutionary new product, its stock price may rise as investors become more confident in its future. Conversely, if a company faces challenges or the economy slows down, stock prices can drop. While stock prices fluctuate daily, the goal of investing is to buy stocks at a low price and sell them at a higher price. 8. How to buy stocks. The first step in investing in stocks is opening a brokerage account. This account allows you to buy and sell stocks through a stockbroker or an online platform. These days, online brokerage firms like Robinhood, Fidelity, TD Ameritrade, and eTrade allow investors to buy stocks without high fees or minimum investment requirements. Once your account is set up, you'll deposit money into it, and you can begin purchasing stocks of companies you believe in. When you buy a stock, you can place a market order, buying at the current price, or a limit order, setting a price at which you're willing to buy. For beginners, it's often recommended to start with low-cost, diversified investments such as index funds or exchange-traded funds, ETFs. These allow you to invest in a basket of stocks, reducing your risk compared to buying individual stocks. 7. The importance of diversification. One of the most important principles of investing in the stock market is diversification. It's tempting to put all your money into one stock, especially if you believe strongly in a particular company. However, this can be risky. If that company doesn't perform well, you stand to lose a large portion of your investment. To mitigate this risk, it's wise to spread your investments across different sectors, industries, and geographic regions. This way, if one investment performs poorly, others may perform well and balance out your overall portfolio. A good strategy for beginners is to invest in ETFs or mutual funds, which automatically provide diversification by pooling together stocks from different companies. 6. Risk and reward. Investing in stocks carries both risk and reward. On one hand, stocks have the potential to deliver high returns, but they can also experience significant downturns, especially in the short term. Stock prices are influenced by factors like economic conditions, company performance, interest rates, and global events. It's important to remember that the stock market is generally more volatile in the short run, meaning prices can go up and down quickly. However, historically, the stock market has always trended upwards in the long run, which is why many investors stay in the market for years or even decades. If you can withstand short-term fluctuations, you stand a better chance of seeing significant growth in the long term. 5. How to build a stock portfolio. Building a stock portfolio involves selecting a mix of investments that align with your financial goals and risk tolerance. Beginners may want to start with a simple portfolio that includes a combination of individual stocks, ETFs, and mutual funds. As you get more comfortable, you can start to tailor your portfolio based on your risk tolerance. A more aggressive portfolio might include a higher percentage of individual stocks, particularly those of high-growth companies. On the other hand, a more conservative portfolio might focus on blue-chip stocks or dividend-paying stocks that provide steady income and stability. 4. The power of dividends. Some stocks offer dividends, which are payments made to shareholders from a company's profits. Dividends can be a great source of passive income, especially for long-term investors. Companies that consistently pay dividends tend to be more stable, making them an appealing option for beginners looking for less risky investments. 3. When to sell stocks. Knowing when to sell your stocks is just as important as knowing when to buy them. Generally, it's a good idea to sell stocks when they no longer align with your investment strategy or goals. For instance, if a company's fundamentals begin to deteriorate, or if your stock price has risen significantly and reached your target price, it might be time to sell. 2. Long-term versus short-term investing. There are two main types of stock market investing: long-term and short-term. Long-term investing involves holding onto your stocks for years, allowing them to grow over time. This strategy works best for people who are looking to build wealth slowly and steadily. 1. Stay educated and patient. The key to success in the stock market is patience. The market will always have its ups and downs, but as long as you stay educated, stay diversified, and remain patient, your investments are likely to grow over time. Investing in the stock market is one of the best ways to build wealth over time. By understanding the basics, choosing the right investments, and staying patient, you can start growing your money today. Remember, every successful investor started as a beginner. With the right mindset and strategy, you can unlock the potential of the stock market and build a brighter financial future. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.